Good day, everyone. Today, I will discuss the financial institution and simple money creation. Now, there are two important concepts in economics and the financial system. First is the financial institution. Let us define what is financial institution. Now, financial institution or monetary institution are organizations that facilitate the flow of money within an economy. For example, is that to include banks, credit unions, insurance companies, and other financial organizations. So these institutions play a vital role in economic development because they perform several important functions. First is they allocate or channel savings efficiently from savers to borrowers. So financial institutions collect money from individuals and businesses who save their funds. They then lend these funds to borrowers who need capital for business expansion, education, housing, and other purposes. For example, when you deposit money in a bank, the bank can lend a portion of that money to someone who wants to start a business. In this way, money is transferred from savers to borrowers efficiently. Second is that they provide information, liquidity, and risk sharing services. Now, financial institutions help people make informed financial decisions by providing information about loans, investments, and savings options. They also provide liquidity, which means depositors can easily access their money whenever needed. Furthermore, they offer risk sharing services through products such as insurance and diversified investments, helping individuals and businesses reduce financial risk. Next is that they provide flexibility and divisibility of funds of users and sources of funds. So financial institutions make it possible to divide large amount of money into smaller units. For instance, that many people can deposit small amounts of money and these funds can be combined to finance large projects or loans. So this flexibility allows both savers and borrowers to meet their financial needs effectively. Last is that they are essential for ensuring capital formation and economic growth. Capital formation refers to the creation of productive assets such as buildings, machinery, and infrastructures. Through lending and investment activities, financial institutions help businesses grow, create jobs, increase production, and stimulate economic development. These financial institutions, economic growth would be such slower because businesses would struggle to obtain the funds they need. So in total, financial institutions are the channel savings to borrowers, provide information, liquidity, and risk-sharing services, offer flexibility in the use of funds, promote capital formation and economic growth, and these functions make financial institutions essential to a healthy and growing economy. Now, let's talk about the simple money creation. So, simple money creation or money creation occurs when banks concepts or accepts deposits and lend out a portion of those deposits while keeping a certain percentage as reserves. This process is known as the fractional reserve banking system. So, understanding the table, so in this example, the initial deposit is 10,000 pesos and the required reserve ratio is 10%. This means that banks must keep 10% of deposits as reserves and may lend out the remaining 90%. First bank is the Zest Bank. Deposit is 10,000 pesos. So it required reserve the 10%, which is the 1,000. So available for lending is the 9,000. So the bank keeps 1,000 and lends 9,000. So second bank is the Golden Rule Bank. So the borrowers spend the 9,000 and the money is deposited into another bank. So deposit of 9,000 and required reserve is 900 pesos. Available of lending is 8,100 pesos. Again, the bank keeps 10% and lends out the rest. Third bank is the patient's bank. The 8,100 loan is deposited into another bank. So deposit is 8,100 pesos. So ang required reserve, it is the 810 pesos. So available for lending is the 7,290 pesos. So the same process continues repeatedly throughout the banking system. So the money multiplier effects as the banks continue lending and receiving deposits, the total money circulating in the economy increases. Although the original deposit was only 10,000, the repeated process of lending and redepositing allows the banking system to create a much larger amount of money. So according to the table, the total deposits of 100,000 total requires a reserves of 10,000 pesos. So the total loans created is 90,000 pesos. This means that an initial deposit of 10,000 eventually supports a total money supply of 100,000 pesos. So a money multiplier formula, the money multiplier is calculated using DM equals fract 1 and RR, where M is the money multiplier and RR is the required reserve ratio. If the reserve ratio is 10% or 0.10, so therefore every 1 pesos deposited can potentially create up to 10 pesos in the banking system. So the importance of money creation is that increase the availability of the credit, support businesses, investment and expansion, encourages economic growth, and helps individuals and businesses such as funds for productive activities. However, central banks regulate this process to prevent excessive money creation, which may lead to inflation. So to conclude, financial institutions serve as the intermediate that connects savers and borrowers, provide financial services, and contribute to economic growth. So through the process of simple money creation, banks expand the money supply by lending out deposits while maintaining required reserves. So this supports investments, business activities, and overall development. Now, next topic is the monetary policy. So after understanding how money is created, let us now discuss the monetary policy. So monetary policy refers to the action taken by the Bangko Sentral ng Pilipinas to regulate the amount of money circulating in the economy. So the main goal of monetary policy is to maintain price stability, control inflation, promote economic growth, and support employment. These are two types of monetary policy. First is the expansionary monetary policy. So the expansionary monetary policy aims to increase the money supply. It is usually implemented when the economy is slowly down or experiences recession. Its objectives are encourage borrowing and spending, increase investment, create jobs, stimulate economic growth. Second is the contractionary monetary policy. So the contractionary monetary policy aims to decrease the money supply. It is usually used when inflation is rising too quickly. Its objectives are reduce excessive spending, control inflation, stabilize prices, prevent the economy from overheating. So the instrument of monetary control is to implement the monetary policy. So the monetary board uses a several instruments. First is the reserve requirement. The reserve requirement is the percentage of deposits that banks are required to keep and not lend out. So these reserves are maintained for safekeeping and to ensure that banks have enough funds to meet withdrawal demands. So the effects of it are the higher reserve requirements, the less money available for lending, and the more and money supply decreases. So lower reserve requirements, more money available for lending, and money supply increases. For example, if the reserve requirement increase from 10% to 20%, banks will have less money to lend, resulting in less money creation. So rediscount rate, the rediscount rate is the interest rate charged by the BSP when banks borrow money from it. So banks may borrow from the BSP when they need additional funds. So the higher rediscount rate, borrowing becomes more expensive. It becomes the bank borrow less. So money supply decreases. So next is that the open market operation refers to the buying and selling of government securities by the BSP. So the government securities include treasury bills and bonds. So money market purchase. So this occurs when the BSP buys government securities from individuals, businesses, or banks. As a result, money enters the economy, bank gains additional reserves, lending increases, and money supply increases. In the open market sale, it occurs when the BSP sells government securities to individuals, businesses, or banks. As a result, as the money is taken out of circulation, bank reserve decreases and lending decreases, and the money supply decreases. So that, hence, the banks create money through the process of lending and redepositing funds. The amount of money created depends on the money multiplier, which is affected by the reserve requirement. Meanwhile, the Bangko Sentral ng Pilipinas manages the money supply through monetary policy, which can be expansionary or contractionary. So to achieve its goals, the BSP uses three major instruments: the reserve requirements, rediscount rates, and open market operation. And understanding this concept help us to see how the financial system influences economic growth, inflation, borrowing, and the overall stability of the economy.